everyone who's worried about Bitcoin's lost their mind. I like the fact that the things I own go through these periods where people don't like them. I do not want to own assets that are always in favor, because if they're always in favor, that means they're popular. If they're popular, that means they're crowded. If they're crowded, that means the return has been arbed away. And so I actually want things that go in and out of favor, because that means that the things that are out of favor likely have a lot more asymmetry to them. They have a lot more potential return in the future. And so that volatility is really important. What's going on, guys? Today we've got a great conversation with John Pompliano. He interviews me all about Kevin Warsh, the Federal Reserve, inflation expectations, interest rates, the AI CapEx question, what's going on with the Mag 7, the S&P 500, Bitcoin, we talk about SpaceX, and many, many other things. And I even explain exactly how I think about investing right now in public and private markets. And I talk about some of the investments that I've allocated to in my portfolio. Here's my latest conversation with John Pompliano. All right, John, what's the first topic?
All right, Mag 7 sell-off recently. Is this a valuation reset, or is this the market kind of rethinking this whole AI trade?
Well, I think the big reason why the Mag 7 has been selling off is because they're long duration assets. So they're very sensitive to inflation. And people were very worried about the Iran war, the spiking energy prices, and they thought that inflation was coming. As I have said over and over and over again, in 2025, tariffs are not going to be inflationary. The second thing I said is that the Iran war, as long as it was short-sighted, it was not going to be some multi-year thing. Then there was going to be a short-term spike in prices, which we've seen in the energy, but ultimately, inflation was not going to be a long-term problem. A huge reason is because there's these deflationary forces that are hitting the U.S. economy. Now, of course, there are going to be people who say, oh my God, inflation went up above 3%. It is high. It is high. No, it is not. Right? What people were predicting, if you go back and you look, is everyone somehow got their brain broken on inflation because they saw it go over 9%. And they just thought that happens all the time. There are very few times in your lifetime where inflation is going to go over 9%. If I remember correctly, the last time that inflation went over 9% was back in like the 70s. That's before I was born. So my entire lifetime, one time it went over 9%. Now, it was horrific. It was very obvious to see that it was going to happen. And if you were paying attention in 2020, we were printing trillions of dollars and putting interest rates at zero. Of course, we were going to get high inflation. But that is a very different manipulation than when you see things like the Iran war or tariffs. And so if you go and you look at the Mag 7, people are basically have two big concerns. The first is if there's going to be higher inflation, then you get these long duration assets that are very sensitive to that, and therefore they sell off. Okay, fine. Get some like multiple compression. The second thing though, is that everyone's worried about the AI CapEx spending. And they're saying, wait a minute, these companies are plowing tons of money into CapEx. And if they plow tons of money into CapEx, that means free cash flow is going to go down. If free cash flow goes down, doesn't that mean the company should be worth less in the future? I'm not going to make as much money from a cash flow perspective. And so ultimately, I think there's two things that are going to play out. Inflation is not going to be nearly as big of a problem as people think it's going to be. You're already starting to see this, right? Energy was responsible for 60% of all increase in the inflation number. So it's all energy. That's what's driving these moves. When energy prices come back down, oil now is below $80. If it goes back to $60, what do you think is going to happen to inflation? I don't know. I don't know if I'm confident yet enough to call the top of inflation, but we're pretty damn close in my opinion. And so whether it actually already peaked or it's going to peak in, the May or June number or whatever, my guess is that inflation is going to be lower in Q3 and Q4 than it was in Q2. If that's the case, then guess what's going to happen to the multiples on the Mag 7? So they're going to expand again. Okay, fine. That's one part of it. Well, what about the AI CapEx? There's two components to this, in my opinion. The first is that the AI CapEx, the whole thing is predicated on, does the demand actually exist that we think is going to exist in the future? And will there be an ROI on this CapEx spending? Well, there will be an ROI if the demand exists, right? Because that means there's going to be someone there to use it. Well, the question of, is there going to be the demand? I don't know. Do you use AI more today than you did a year ago? Of course.
So that was the big narrative that people were talking about, though, was now the whole media is all talking about, hey, are we being efficient enough with the AI tokens that we are using, and is like the actual energy that we are consuming worth it for our business?
Well, if you go back, right, in May, I think like May 20th or May 22nd, something like that, I started tweeting and saying, I personally was experiencing, we're building a product called CFO Sylvia, as many people know. And in that product, one of the things that happened is we started to see cost run because the users get to generate the queries, which means that they are basically it's unlimited exposure to expenses if you are not intelligent about how you manage those tokens. So when you first start building these products, you're trying to make the product work. Then you realize, oh, there's a problem. Token expense. Okay, how do we get more efficient at token expenses? So some of the examples were when people would refresh certain pages, it would hit the model. Well, like, we don't need to do that. Stop doing that. Okay, that takes down the token usage. The second thing is that there were certain features that were persistently hitting the model every, certain amount of time and surfacing information. It was cool, but it was one of the biggest draws on our token usage. So what do? We killed the feature and we just said, let's see if anyone complains. No one complained. So we just didn't bring it back, right? Just saved a bunch of tokens. So like, we started to get smarter. Then we created some architecture changes. Then we started to look at caching. We started doing all these things. When we were doing it, I thought it was just a us problem. I was like, hey, we got to solve our own problem. Then I started to talk to a bunch of CEOs. So I went and I talked to friends who run all these companies, and they all were saying the same thing. They're like, this is crazy. We're spending all this money on these tokens. I have no clue if I'm getting an ROI off it or not. So what did they all do? They started to say, I want the output with less token usage. And so there was a huge shift. That's why I started tweeting about it, saying this idea of like token maxing or these leaderboards inside these companies, this is not going to be where the world ends up. We are going to go back to efficiency and effectiveness and measuring ROI and all this stuff. Now, what I find most compelling for OpenAI, Anthropic, Grok, any of these private companies is that you have your individual customers, so CFO Sylvia or any company saying, I need to consume less tokens, but I need to get the same output, right? So we're becoming more efficient. Yet the total addressable market is growing. The adoption of your product is growing. So your revenue is still sky high, even though your individual customers are becoming more efficient with their token usage. So to me, that is a sign that these people have product market fit. The product is going to continue to grow. I think that they have an incredible business, all bite, as long as the open source models don't eat their lunch, right? But for right now, these guys are doing a great job. So then the question becomes, okay, what is the limiting factor for using this technology? Power, data centers, chips, right? You just go through all these different components. And so if you go, I just saw a story that there's a company that is shifting their work hours to 1 a.m. to 10 a.m. They're asking their employees to work from 1 a.m. to 10 a.m. One of the cited reasons is because they believe that the usage of the models from 1 a.m. to 10 a.m. is not only cheaper, but there is less demand on the systems. And therefore, they also believe that the answers are more accurate during that time frame. Now, I don't expect almost anybody else to go do that. That is a very unique situation. But people are obviously thinking about this stuff. And so if there's going to be this persistent demand for this technology, then that means that we don't yet have enough data centers, power, chips, et cetera, which means that there's going to be this persistent bid. And so everyone who is worried about the ROI on the CapEx spend, could we get to a point at some point where we've overbuilt? 100% happens in every cycle. It's very hard to have finite control of this stuff. But I don't see that anywhere in the short term. And so I think that demand for the software is through the roof. I think that there is demand for specialized workflows. That's through the roof. I think there's demand for data centers, power, chips, et cetera. So much so that we literally have a company that's saying that they're going to go build it in space, the orbital data centers. And so I just think that this whole idea is a little misplaced. Now, when it comes to the Mag 7 in particular, one thing that I think that we will start to see is that everyone is going off of a projected CapEx spending. It's like projected revenue. They didn't book the revenue yet, right? But they also didn't book the CapEx spending. Now, in some cases, they're making commitments or they're projecting what they're going to do. But what we have to get is the actual data. And so I think that it would be very interesting if they say, just take easy numbers. Hey, we're going to spend $10 billion in CapEx spending over the next 2 years. But we get the actual numbers in, it's like $6. Still $6 billion of CapEx spending from a single company. But it's not 10. It's a 40% less CapEx spending than what was perceived. And so I just think that people are very caught up right now in, what is inflation going to be? I think that's very mispriced in the market and people don't understand it. But more importantly is this AI CapEx. I don't believe the numbers that the guidance is. I actually think that they're going to spend less than that. And so again, if you look at the Mag 7, go look at some of the companies. Google has sold off in recent days. Okay, why is that interesting? Google is now cheaper than Apple, but it's growing faster than Apple. So the question becomes, why? It is all related to AI CapEx spending. And so if you go and you actually look at the information, if you actually go look at the data, I think that there's going to be a very big opportunity to own some of the best businesses in the world at lower valuations and go look at like the PE multiples. Go look at some of these metrics on these businesses. They have come down substantially over the last couple of years, and they now are in valuation ranges where I think a lot of investors should say, doesn't seem that crazy to me, right? As long as this AI CapEx thing isn't a problem, like, I don't know, it becomes pretty attractive to go and allocate to these businesses. And so I just think that everyone just needs to calm down, stop freaking out. And these AI companies, they're not going to be some huge implosion. They're not going to be zeros, at least in Mag 7. And I think that you've got to look and say to yourself, is the company that we're looking at today any different than it was 3 weeks ago? Remember, the Mag 7 is up 18% in the last year. You wouldn't know by reading the headlines. Everyone is trying to convince you that the Mag 7 is over, it's lagging, it's lagging year to date, 100%. But the S&P is still up 9% for the year. The other 493 stocks are up 13%. The Mag 7 is like flat to slightly down. Okay, so it sounds like the Mag 7, doesn't work anymore. Well, hold on a second. If the Mag 7 is still going to be valuable, shouldn't you become more interested in owning the Mag 7 because all of these other stocks have run and these haven't moved in valuation for 6 months?
But the Mag 7 ran first.
Of course, it's up huge over the last 5 years, right? So like, could it be a cooling off? Could it be a consolidation? There's all these things, the theories that people have. But the point just being that imagine being able to buy the same business today, to buy the business today after getting another 6 months of great data of growth and profitability, et cetera, but be able to pay the price from 6 months ago. That's pretty much what the Mag 7 is letting you do. Now, that doesn't mean I'm taking my whole portfolio and going and plowing into the Mag 7, right? But I think that if you are some sort of value investor, if you're a large cap tech investor, if you're more of an index type person, I would not be worried about the Mag 7. I actually think it's becoming more attractive there. And so I just think that all of the concerns are really overblown. And I think that people are bored. That's what I ultimately think. I think there's a lot of people who are like, we're in this, generational bull market. There's not that much stuff to talk about. So let's start inventing problems. Let's start just pontificating about things that could go wrong. Great. If you want to be a risk manager, sure, you should be thinking about what the possible problems are. But I like to focus on the problems that I know are real problems, right? I don't like thinking about things that, maybe one day if it's raining outside, a squirrel comes out of a hole and a peanut drops from the tree, then that's going to be a problem. I worry about things that are actually problems, and AI CapEx spending right now is not actually a problem. Could it become one? Maybe, but right now it ain't a problem. Today's episode is brought to you by Fountain Life.
Your body is incredibly good at hiding disease, unless you look.
Wealth isn't measured in possession. It's measured in the time you gain, the energy you feel, and the life you create. It may be the smartest investment of your time you'll ever make.
Life is so very, very precious, and I want each of you to be truly awakened to your aliveness and live longer without limits.
Your number one job is to educate yourself, and Fountain wants to help educate you.
Okay, so if it's not a problem, how do you measure it, right? How do you measure success on this stuff? Is it user growth, revenue growth? Are there, should you look at margins, free cash flow? Like, how should a business be thinking about, are we getting what we want out of this AI CapEx?
Well, forget the AI CapEx for 1 second. The profit margin of the S&P is up 58% since 2011. So in a little more than a decade, the profit margin of these businesses has increased 58%. They're better businesses, so they should be valued higher. And I think people kind of forget this shift from like an analog world into this digital world where these companies have, IP and they're selling digital products and they're providing all this stuff. They are more efficient, more valuable companies. So everyone keeps pointing to like, oh my God, look at the historical valuations. Look at the dot-com bubble. Like, dude, the dot-com bubble, you had to print out physical paper from MapQuest to try to find how to get to the other side of the city. What are you talking about? iPhones, AI, right? Like I went recently to our San Francisco office for Sylvia, and I was sitting with some of the engineers, and I said, hey, can we make a change to something? And they're just typing in Claude, right? Now, they understand, they're engineers, right? They understand how the technical architecture works. They understand how a lot of things that get broken, they can go in, they can fix it, the databases, the file system, all this stuff, right? But at the end of the day, they got magic. Like, they're magicians now. And so trying to compare the valuations in 2026 to valuations from 1992, you lost your mind. And that's why I think that the value investors have lagged significantly. I think that's why the tech investors have done so well, is you should be aware of history, but you cannot simply just point back and say, oh my God, these things are so overvalued compared to everything else, because you've been saying that for 15 years. So is it that you are going to claim victory if there's a 20% sell-off in the stock market? And you're going to say, oh, see, it was overvalued? Or are you going to shut up and get in the car and participate in a generational bull market? And I think that what you see is the best investors in the world, they're participating, whether it's Warren Buffett or it is name your favorite investor. They all have realized these are real companies with real profit that are solving real problems, that have real growth in front of them. And so you got to allocate to them. And if you think that you're smarter than the market and you're going to sit on the sidelines and you're going to critique everybody, great. But the way you measure success is, do the businesses produce profits? Okay, well, they all are producing a lot of profit. That's why they're so valuable. And people are worried about the free cash flow and all this stuff. The profit margin of the S&P has increased 58% since 2011. Do you think it's going to keep increasing? 100%. So these businesses are getting better over time. They're aging like fine wine. Well, you probably want to own some of them rather than sit on the sidelines and, pontificate about how smart you are and how stupid Mark Zuckerberg or Jeff Bezos or Andy Jassy or, Sergey is. Like, give me a break.
I like that. That was good. When you think about these Mag 7 companies, though, I think most investors are under the idea that in 10 years, these things are going to be worth more than they are today. So that's what most people are looking at. How do you think about the short term and positioning yourselves from, hey, these large cap stuffs to, there's crypto, there's all these other like kind of components to the market. And then we'll kind of bring this back.
Well, I don't really care about the short term in the sense of I don't look at things on a day-to-day basis, week to week, even month to month, right? So I like to buy things and say to myself, I'm going to hold this for 10 years. And that's my general kind of time frame. And over that period of time, I'll find more things. I spend most of my time trying to figure out, how do I make more money? How do I go and actually get more capital? So if I bought something and I like to hold it for a long period of time, then I'll just go make more money and then I'll buy something new if I want to add something to the portfolio. Now, with that said, doesn't mean I don't always hold things for 10 years, right? Every once in a while, if the thesis changes or something, I'll make some changes in the portfolio, but I don't do a lot of changes. Now, with that said, if you go and you look, there's basically two ways to invest, right? If you go, and I forget the exact number off the top of my head, but I think that the NASDAQ is up over the last decade, has delivered something like a 18% return annually. I mean, that is bonkers, right? If the NASDAQ is producing 18, 20%, whatever it's been, compounded for a decade, what's been better than that? There's not many people who could beat that, right? And so you go and you look at it and you say, like, investing in these like large cap indexes is a great investment strategy. You also could invest in things that are super asymmetric. What I think is the problem is the middle ground. What you don't want to do is you don't want to allocate to mid-sized companies that have mid-sized growth trajectory and have mid-sized return profiles, right? Because that middle ground doesn't provide you the safety and security of the large caps where there's tons of cash flow and a lot of resilience and kind of toughness to the business, and which creates durability, that durability you get paid for, right? And it also doesn't provide you the asymmetry of something that's very small and fragile that could grow into something big. So I like to operate in the barbells. I don't like to operate in the middle. Now, if I go and I look, Bitcoin and AI, to me, are the two most interesting technologies in the world. Now, a lot of these two technologies are being infused into tons of other things. So what you're seeing in finance is people are putting Bitcoin in all kinds of stuff, right? The BlackRock website recently had a huge, advertisement on their homepage for the IBIT, ETF and a bunch of products that they're building around it, et cetera. Like that, there's no more mainstream than being on the homepage of BlackRock, right? At the same time, AI, look at SpaceX maybe as an example. SpaceX, largest IPO in history, $85 billion, whatever it was, comes out super hot. What is SpaceX? Is it a space company? Is it an AI company? Is it something else? Right? And you go and you look and say, okay, there's a couple ways to look at it. They have a monopoly on space launches. That's pretty valuable, right? They're putting Starlink up and they're beaming the internet down from space. Pretty valuable. There's the promise of orbital data centers. So you look at all of that and you say, okay, it's like a space satellite, maybe a orbital data center company. Okay, great. Well, if you go back and you look at the IPO presentation, they had a slide that was all about the total addressable market and the rocket launch, market, then the internet satellite business, right? They had all this stuff. And then they had enterprise AI. That was like, I forget the numbers, like $28 trillion of the like $30 trillion total addressable market, whatever the numbers were. But it was like the majority. SpaceX is an AI company. That is why they are valued the way that they are valued. And they've now, or at least entered into the agreement to acquire Cursor, right? They've got XAI. They've been signing up a number of contracts. I think they signed in the last 3 weeks, 3 different contracts that are all at least $100 million a month for the compute that they've put together. So you start to look at this and you say, wait a minute, this is a business that's doing billions of dollars, tens of billions of dollars, maybe run rate on a compute business that didn't exist 2 years ago. So what does that trajectory look like? Again, it goes back to the AI CapEx ROI. Well, like, you think that's been valuable for XAI and SpaceX? Of course. So I start to look at, okay, what am I interested in, right? I always hold some cash. I like Bitcoin. And then I want to be exposed to where growth is, where innovation's happening. And to me, that's happening in this whole sector that is related to artificial intelligence. Now, that doesn't mean you got to just play the software, right? There's obviously all the hardware stuff and power, et cetera. But if you look at some of the things I own Tesla stock, right? Why do I own Tesla stock? I believe that if Elon has a monopoly on humanoid robots and self-driving cars, that's going to be really valuable. I also believe he's going to merge SpaceX and Tesla together. He's probably going to do it before 2030. And when he does that, I think he's going to create this, conglomerate of all of the things that Elon is working on, but it relies on hardware thinking and seeing. And if he can make hardware think and see using artificial intelligence, machine learning, computer vision, et cetera, then he is going to have the embodiment of the physical AI space. And I think that's going to be really, really valuable. Another thing I own is RoboStrategy, the publicly traded closed-end fund that has exposure to all of the private, or a lot of the private robotics companies. Why do I think that's interesting? Physical AI and robotics, right? Coming together. It is a way to get exposure to the private market. So you've got a public entity in Tesla, right? Then you've got RoboStrategy getting you access to the private. That to me is all physical AI and robotics. I think it's going to be a huge opportunity. Masayoshi Son recently said it's the next $1 trillion opportunity. If you go and you look at a lot of the different technologies that are being built, a lot of the applications, et cetera, I think that's going to be big. Another area that I think is really interesting is things when it comes to national defense and a lot of this technology. So for example, I've been pretty public about the fact that I own Ondas stock, right? Ondas is got a really interesting business model. One of the hard parts about the drone industry is that there's so much technical aspects to actually making the drone work and creating innovative technology. So usually the teams that are needed to be able to create the technology are not the teams that are really good at commercializing it and building a company. And so what their business model is they let a bunch of startups go and have the technical breakthroughs. Once they prove that the technology works, they step in and they buy the drone company. And then they're really good at the M&A part of acquiring these. But then they have a huge BD team, or a very effective BD team, and they go and they basically start getting the commercial contracts. And so all they are is they acquire technology and then they go and they commercialize the technology, right? But the reason why I like it is because you have national defense. Again, you have AI, robotics, machine learning, et cetera, and the drones themselves. And then they even are pushing into drones not just being in the air as we think, but also on land and in the water. And so you can see a theme emerging from all this stuff, right? Is in the private market, I've got exposure to a lot of the software type, companies. Replit, Lovable, Micro One, those types of businesses that are very popular and have dominated their specific verticals when it comes to software. My public portfolio, though, is much more focused on physical AI and robotics. And so I feel like I've got a full stack exposure to AI between the public and private market, between software and hardware. So that's like one whole big piece. Obviously, Bitcoin, I'm a huge believer in. I think that Bitcoin is going to continue to be the check and balance on the federal government printing an insane amount of money and manipulating the monetary policy and having insane fiscal policy. If that's the case, then we're going to see the national debt continue to explode higher. They're going to debase the dollar, and Bitcoin will do very well over a long period of time. Everyone who's worried about Bitcoin's lost their mind, right? So that's fine. But I like the fact that the things I own go through these periods where people don't like them. I do not want to own assets that are always in favor, because if they're always in favor, that means they're popular. If they're popular, that means they're crowded. If they're crowded, that means the return has been arbed away. And so I actually want things that go in and out of favor, because that means that the things that are out of favor likely have a lot more asymmetry to them. They have a lot more potential return in the future. And so that volatility is really important. Think about the things I've talked about: Tesla, RoboStrategy, Ondas, Bitcoin. Like, all these things are super volatile compared to, just owning Walmart stock. And so that's really what I'm looking for. Is I'm looking for thematic volatility, where I can go and I can put these things into a portfolio and I can play a major theme and do it across public and private markets.
Do you see that more on the consumer side or the picks and shovel infrastructure side?
Well, think about Tesla, right? What is Tesla? Tesla is a lot of people would say self-driving cars and humanoid robots. And so they are not really a picks and shovel type provider. They instead are this like consumer type company, and maybe they'll sell the humanoids to enterprise and consumers both, right? Whatever. Okay, maybe. I actually think of Tesla as a picks and shovels company. What do I mean? The value to me in Tesla is not in the hardware. That is the way they monetize the thing that is valuable. But really, to me, it is the computer vision, machine learning, artificial intelligence. It's all the models, the data, the real world application, and the specific workflows in terms of how do you take all of these models and this data and then make the hardware do something. So that is as picks and shovels and infrastructure as you get, is owning the actual models. That's why OpenAI and Anthropic, all these guys, they're getting injected into all these people's products. Usually people think of picks and shovels and they don't think of, something like a model, right? Because they're like, oh, a consumer, interfaces with it. Yes, consumer interfaces with it, but also how much of the revenue is actually coming from non-consumer use cases? A lot, right? And so I think that Tesla is, to me, a picks and shovels company because of what is valuable in that product or inside that company. But people just think of it as a consumer company because it interacts with or gets money from the actual consumer, but that's not how I look at it. Today's episode is brought to you by BitGet. BitGet is the world's first universal exchange, serving over 125 million users with access to over 2 million crypto tokens and TradFi markets such as 100 plus tokenized stocks, ETFs, commodities, FX, and precious metals like gold and silver. They officially opened its TradFi trading suite on January 5th, 2026, and has already hit the milestone of $4 billion of daily volume just days later. Users can now trade 79 instruments across global macro assets such as Forex, precious metals, indices, and commodities directly with USDT, all within their existing BitGet account. This experience is designed to feel familiar to crypto native traders while opening the door to macro-driven strategies without the need to switch platforms. Users can also enjoy high liquidity and low slippage while trading these assets with up to 500x leverage. The BitGet ecosystem is committed to helping users trade smarter with its AI agent to execute trade orders as a co-pilot. BitGet is driving crypto adoption through strategic partnerships with La Liga and MotoGP. Aligned with its global impact strategy, BitGet has joined hands with UNICEF to support blockchain education for 1.1 million people by 2027. BitGet currently leads in tokenized TradFi market, providing the industry's lowest fees and highest liquidity across 150 regions worldwide. Check them out at bitget.com today. That's bitget.com today. All right, guys, let's talk about something that's actually moving the needle in crypto right now. And that's my guys over at Arch Public. These guys are killing it. They continue to lead the way in everything that's got to do with agentic trading. And everyone knows that nothing else is being talked about in the market other than let your AI agents trade whatever asset you want. Now, with the addition of Arch AI, the market wave algorithm, and their tax harvest tool, they have turned this into a true one-stop shop for automated trading. They have now over 25,000 users, and that includes several corporate treasuries, asset managers, and businesses. And so the testing phase for Arch Public, that is over. They have perfected how to automate advanced trading strategies without ever taking custody or asking you for your private keys. It's a big deal, obviously. So Arch Public is an action speak louder than words type company. That's what I like to see. They give every user access to their platform absolutely free. You get to test it, you run the strategies, you watch the performance in real time, and then only after all of that do you put real money in to go put it to work when you're 100% comfortable. That's it. No pressure, no hidden fees, no gotchas, none of that nonsense. Go to archpublic.com right now and you can get started for free. Once you see how you can accumulate and manage crypto this way, you'll never trade the same again. archpublic.com, go check them out today.
Gotcha. Let's switch gears a little bit. Let's talk about Kevin Warsh. And
Big dog.
You think we're getting rate cuts this year? Kelsey's got it at 78% for 2026. No cuts, same rate. Next meeting's in July. They got it at 77%. No cuts, no changes.
Well, let's go through from first principles. What has to be true for us to get rate cuts? We have to have lower levels of inflation. We have to have a Fed chair who believes that we should have lower rates. And we need to have an economy that can handle lower rates. So those three things are somewhat interconnected, right? Because if we have lower inflation, that means the economy likely can handle having lower rates. And if we have lower inflation in an economy that can handle it, then we need somebody there who can make that decision, has the courage to do it. I believe that we will get a rate cut at some point in 2026. I understand that people think we're going to get a rate hike. Again, it goes back to my belief that inflation is not nearly going to be as high nor as persistent as people are predicting. Now, what's interesting, I do not think that America will become more affordable, but I think that affordability and inflation are two different things. Inflation is an economic concept that central bankers and sophisticated investors care about. Affordability is what the average American cares about. They don't care what the rate of change is. That is like some textbook academic nonsense to them. All they care about is I go to the grocery store, my bill's too high. I can't figure out how to take the money I'm making and pay for the things I want. Life's not affordable. That is a problem. That's very different than going to somebody and saying, I know that the US dollar lost 30% of its purchasing power in the last 5 years, but the rate of inflation now is only 2%. Investors would be excited about that, right? Central bankers would be excited about that. Inflation's under control now. And therefore, that would mean that, hey, we've got this like strong economy that we don't have to worry about the high inflation, which would lead to lower rate cuts or more rate cuts. Average American don't care. They don't care if inflation is 2 or 3%. That number means nothing to them. That might as well be the same number. All they care about is affordability. Mm-hmm. So if you go back to and you look at, well, okay, is inflation going to be a problem? I don't think so. If you then go and you look at, can the U.S. economy handle lower rates? I do believe that. A huge reason for it is, if you look right now, the American consumer is super resilient. Spending data looks amazing. And on top of that, you have a stock market that continues to grow. And then on top of that, household wealth is growing. Now, real wages have struggled and had some headwinds. So you got to get that back in right shape. Some of that is inflation coming down because energy prices come down, the Iran war stops, et cetera. But if we get towards, let's say, Q3 and that inflation number is coming down, Kevin Warsh is something we call trigger happy. He's sitting there ready. He's got his finger hovering over the button, right? Now, he doesn't make the decision exclusively. There's the FOMC and the whole thing, right? But my guess is that if that inflation number starts to come down, they're going to hit that button. We're going to get a rate cut. Now, I don't think we're going to get 3 rate cuts or anything crazy, but I could easily see them doing a rate cut, which is kind of a check on the market. Like, hey, look, we are willing to do this. Now, what would change my mind is if inflation did stay persistently high, or if we did see some sort of weakness in the U.S. economy. I just don't see that right now. And so I think that before the end of the year, we're likely to get some sort of rate cut. I think you'll see the prediction market odds all change. But I also don't think it's a bad scenario if rates just stay the same, right? I don't think that they are necessarily hurting the U.S. economy by keeping them where they are. I do think if they hike rates, it would be premature. I think that it would be ill-advised, and I think it could actually create a lot of problems. But if they kept it flat, fine. I think they should cut, but that's fine if they want to keep it flat. I don't think it's that crazy. And then maybe I'd put it at like 60% odds that we get a rate cut before the end of the year.
Now, do you think he's coming in from a position, and I know you're not him, so I'm not going to act like you can speak for him, but is he coming at a position of, hey, let's do something because something is better than nothing? Or is this hey, let's evaluate, let's take, the first couple of months, let's kind of see what the market is doing, look at the data a little more often? Because I find it interesting that it depends how you look at it, right? You can look at credit card delinquencies, and you can quickly understand the consumer is not doing as well.
Well, that's a credit
spending.
That's a credit card problem. That's not a consumer problem, right? I think that's a key piece to this. If I remember correctly, the average credit card interest rate in America is something like 23%.
That's high.
If you don't pay your credit card off at the end of each month, you're screwed because this thing's going to fly, right? Okay, so is that a consumer strength problem? Because consumer spending is off the charts. Now, people may say, oh, it's with credit cards, whatever. Like, not really. Now, if the credit card interest rate was 5%, what would be the outcome? You probably wouldn't have as many credit card delinquencies, right? Now, I don't believe that they should cap the credit card interest rate, because I think that they're going to be putting the government in there. They're going to manipulate it. A lot of the credit card companies just stop giving credit to people, right? So they're trying to price credit, and the credit that they've deemed is over 20%. So that's just what it is, right? Is they're using their math to try to figure out what that credit card rate is. Now, with that said, if you go and you actually take a look at Warsh, his entire press conference, his statement, all of the commentary around the Fed meeting, he pretty much did what I would consider a economic sleight of hand. What do I mean by that? He did not touch interest rates. He said, we're going to leave this where it is. But he is rejiggering the entire Fed. He's creating a task force. He's changing the metric in which he wants to look at to actually measure inflation. He's coming in and he is saying that he doesn't believe some of the things that have been going on previously. He's not going to give future guidance. I mean, these are seismic changes that if you took just one of them and Jerome Powell had did it, it would be headline news for a couple of days. If Jerome Powell all of a sudden came out and said, we're not going to give forward guidance anymore, oh my God, these people would be going nuts, right? But because you have change at the leadership level, the new person gets to come in and kind of change a lot of this stuff. But he did it without cutting interest rates. He did it without touching the interest rate. So it was almost like a balance beam, right? Like if I don't touch this, I can make a lot of changes over here. If he had cut interest rates, he couldn't probably make all these other changes as well. And so he's chosen, along with his colleagues, don't touch the interest rate. Let's get some more data. Let's kick the can down the road. But then he has chosen the things under his purview where he probably has a lot more control without the FOMC, weighing in, saying, hey, I'm going to make these changes over here. And he's laying the groundwork. He's creating the culture, the environment. He's probably making personnel changes. I wouldn't be surprised if we start to hear that, to make sure that the right people are in the right seats. And he's got the organization optimized in a way that he thinks is best to oversee monetary policy in America. And I don't think that a lot of the things he said were that controversial. I understand some people don't like it or don't agree with it, but it all kind of made sense to me, right? He's like, look, we got to make sure we're looking at certain metrics that don't take in for the temporary spikes in certain prices. We got to make sure that we're not trying to predict the future because then we get boxed into doing that thing. Like that doesn't seem crazy to me. So I think that he's off to a pretty good start. I think I gave him I can't remember, I think on a scale of 1 to 10, I gave him like an 8 or 8.5. It's not a 10, he didn't get an A+, but he also didn't get a C. He C's get degrees, but he got he was up in the B+ range.
B+?
Yeah.
Okay. All right, but
I'll
not
take
net.
that. I would have loved to get that grade in high school.
All right, let's switch gears a little bit. Let's talk about Bitcoin. Over the next 10 years, what's your bear case and bull case for Bitcoin?
Well, Peter Schiff recently admitted on national television that he doesn't think Bitcoin's going to zero. So, he's like the last of the Mohicans. If he's not going to, I think it's going to zero. I think a lot of people are like, all right, it's unlikely that it's going to go to zero. Now, with that said, could it drop significantly? Sure. But I do think that Bitcoin has breached, kind of the last big wall, which was getting institutional adoption. And now that it has it, I think that there's a lot of folks who say, wait a second, this thing that was super shiny, asymmetric, highly volatile, kind of the king asset of cowboy land, it's not that anymore. And so a lot of my friends aren't buying as much Bitcoin as they previously had been because they're like, what's Bitcoin going to do? Go up 30% a year? Okay. But I can go and I can invest in ABCD, things and I can do better than 30%. Whereas I know a lot of institutions that are like, you're telling me there's an asset that I could buy. It's going to go up 30% a year for a decade. I'm very interested in that, right? And so the compression of volatility from, 80 vol asset down to 35, 40 or whatever it is very attractive to large pools of capital. And so the upside case here, I think, is you are not going to see the, 10x, 20x type bull markets, but you're going to get this asset that's going to continue to compound. My base case is 25 to 30% for the next decade. It's not what it did in the past. Better than the stock market. Right? I mean, if that's like the index, how many people are able to produce a 25 to 30% return annually for a decade? Not that many people. And so I think that it's going to do very well. But I always remind people that unhappiness is the gap between expectations and reality. So guess what? You can't have outsized expectations because you're probably going to be disappointed. So if your expectation is 25, 30% and it does better, great, you're ecstatic. But if you think it's going to do 100% a year, then you're insane. And so it's just like keep rational expectations. The asset will do well. It'll continue to gain adoption. It'll continue to grind up. The government will keep printing money. Like the Bitcoin thesis is intact. It's just that it is playing a different game now, right? It kind of Bitcoin went from playing high school basketball and you're like one of the 10 people on the court right now are going to the NBA, so now we're like in college, right? Everyone is much better, and there's a lot less variation on the court, but also everyone's much better. So the game is better, right? It's more fun to watch. It's more likely to be good basketball. At some point, we're going to get to the NBA, sovereign wealth funds, all that stuff, right? We're not quite there yet, but we're like college basketball, maybe like a Duke game.
Does this feel different than 2022? And the reason I say that is the bear market, it just like consumer sentiment to me has never been worse. Institutional adoption and excitement about Bitcoin has actually, I don't think, ever been higher. What's the difference in these bear markets?
No, internet Bitcoin sentiment is bad.
I don't know. Maybe it was because we were living in Miami and now we're in New York, but it feels different.
Internet consumer sentiment is bad right now. I got people I have known for a long time. They sharpshooting each other. They're saying all kinds of crazy stuff. People rage quit and all that nonsense. Nobody's doing that stuff in the institutional world. They may not be allocating as much to Bitcoin, whatever, but like they're much like calmer. They're much kind of like cooler head, right? They have investment committees, they have risk management, they have, kind of more data driven, all this stuff. So I do think a generalization that has truth to it is retail investors tend to be much more emotional. Institutions tend to be a little bit less emotional. Not all, still humans, right? So there's still some emotion, but a little bit different. So I like to say that internet consumer sentiment is down. Institutional sentiment is fine. I don't think it's like sky high euphoria and like there's a bunch of frothiness, but they're still investing in building out all these technologies. They are still going and trying to create, Bitcoin related funds. They're still going and building custody solutions. They're doing acqui-hires of, investment teams. Fidelity just went and Franklin Templeton just recently went and did this. We've also seen a bunch of things happen in terms of OKX and ICE just partnered with each other to go create a bunch of products. Like there's just stuff happening. So when people say consumer sentiment is bad or investor sentiment is bad, they're using the internet as a proxy. But there's a balance. It used to be 100% of everything that you needed to know about Bitcoin was on the internet. I literally used to be able to tell you what the price of Bitcoin was up or down based on what I saw on the internet. I can't do that anymore, right? Because now you have a whole new player in the space. And so maybe it's like 50-50. 50% of the information and importance, et cetera, is on the internet and 50% is in the institutional world. But it used to be 100 and 0. With 0 being the institutions. So it's 50-50 now. In 10 years, is it going to be 80-20, 90-10, whatever. So like the institutions are becoming more important. They have more capital. And the individuals, some of them are capitulating and they're moving on to other things. And so, I'm aware of it. I don't like seeing my friends all argue with each other, but also at the same time, you kind of needed to happen to get the bottom, right? And so I don't know if we've hit the bottom, but we definitely came down. There's a lot of signs that say we could have hit the bottom, and let's see what happens.
All right. Appreciate your time. Thank you.
All right. Thanks for doing this. Everyone go check out CFO Sylvia, just CFOSILVIA.com. See all of you next time.